One day, the Italian economist Vilfredo Pareto was in his garden and he had a eureka moment. He noticed that 80% of the peas mutter in his garden were produced by only 20% of the pea plants. And he thought to himself, what if this 80-20 distribution can be observed in other aspects of human life? And first of all, he tried to apply it to the field of economics. And in 1906, he observed that 80% of Italy's wealth was concentrated in the hands of only 20% of Italy's population. And this 80-20 distribution has now come to be known as the Pareto principle, and it's been observed in many different fields. So for example, 80% of the crime is committed only by 20% of the criminals. 80% of social media shares are happening only on 20% of the posts. 80% of any industry's profits are usually earned by only 20% of the companies in that industry. Now, that's all well and good, but your question is now, what's your point, Rahul? And my point is, what if we can use this 80-20 principle to actually eliminate 80% of the mistakes that cause our portfolio to earn bad returns by doing only 20% of the analysis correctly. And in this video, we're going to do exactly that. Now, if you think of stock selection as a process with multiple steps in it, it can look something like this. And we believe that by doing the 20% correctly, the first step, the screening step correctly, we can drastically reduce the probability of, investing in average or bad businesses that cause 80% of the damage to our portfolio, while simultaneously increasing the probability of investing in great stocks. Right? And even within the screening process, there are two steps. Step number one is we first use very stringent parameters to narrow down from the list of thousands of stocks to a list of 50 to 100 stocks. We've made a video on that. I'll link it somewhere in the video. Step number two within the screening process is to use a detailed but 3 to 5 minute kind of analysis using an Excel template. And if you stay with us towards the end of the video, we're going to share how you can use that template in your process as well. Now, if you're new here, if this is your first time, my name is Rahul. I'm an independent research analyst. I'm a CFA level 2 candidate, and I went from being 45 lakh rupees in debt at the age of 22 to retiring by the age of 29. And on this channel, the whole idea is to share everything I've learned along the way, everything I'm learning today, right? So in this video, we've already discussed why this process can be very, very important because it helps us to reduce the amount of mistakes. We've also discussed where this analysis fits into the overall stock selection process. Now what we're going to do is we're going to discuss how to actually practically apply it. And we're going to apply it on 3 companies from the tiles manufacturing sector. So this is going to be a purely quantitative analysis. This means that we'll be looking at numbers such as sales growth, operating profit margin, net profit margin, free cash flow, turnover ratios to judge the quality of the business. And remember, what we're trying to do at this stage is we're trying to find anything that is meaningfully problematic with the company so that we can eliminate it straight away. Right. With that said, there are a couple of sections. So this whole sheet has been broken down into about 8 sections. Some sections are more important than the others, but every section is basically giving us some important information about the nature of the business. So for example, section number 1 is basically the income statement. It tells us about the sales growth. It tells us about the operating profit margins. Operating profit margins in turn give us a hint about whether there is a competitive advantage in the business or not. Then section number 2 is more about capex, how much the company needs to reinvest to continue maintaining its current assets, but also growing from there. Section number 4 is basically the profitability ratios. Section number 5 is about the working capital related ratios. So this is how the whole sheet has been divided. Now, what I'll do is, as I'm going through the explanations, I'm not going to be going into a lot of detail. So what I'll do is I'll write a blog post and I'll link it in the description so that you can use it and understand each of these ratios and how to interpret them, all of that. Right? So I'll create a different blog post and put it on in the description. Now, with that said, let's start off with the company Kajaria Ceramics. And the first thing that we're going to look at is the sales growth. And if you notice, sales growth, usually in most sectors, it is cyclical. In this sector, It is definitely cyclical because styles are in turn dependent on how the real estate sales are doing. And so if you notice 14, 15 were great years in terms of sales growth at 16%, 19.1%. And then you had a little bit of slowdown. Then 18, 19 again, not great. 20, not great. And then we're seeing a sharp increase in March 2022, right? But the important point to note is a company like Kajaria has grown faster than the industry. This means that, it has been taking away market share from its competitors. And also the reason why sales growth is so important is because all other things constant, a higher sales growth equates to a higher profit, right? So this is sales growth is a very important parameter in the whole equation. The second thing we want to look at is the operating profit margin. And what we're really looking for in the operating profit margin is how variable it is, right? So even though this is a cyclical sector because styles are directly dependent on the real estate sector, still you will notice that the operating profit margins are relatively stable. So on the high end, they're going up to 19%. And on the low end, they're going to 15%, right? So they're relatively stable. And obviously, we'll compare it to the two other players within the industry to get a sense of the variability and how stable the operating profit margins are or they're not, right? The third thing we want to check is net profit margin. Now, net profit margins, again, are ranging between 7 to 10%, 10% being, the higher side and obviously 7% on the lower side. So far, things seem to be great, at least in section number 1. There's no particular problem over here. And so we'll move on to section number 2. Now, one thing is we want to know is net profit after tax over the last 10 years, whatever the total is, that we need to compare it with CFO. Again, I can write a blog post, explain it in more detail, but the simple reason is that net profits don't necessarily reflect how much cash profit the company is generating, right? And the reason is because depreciation, although is an expense when you calculate the net profit, depreciation is not like cash doesn't actually go from the company's account, right? Depreciation is a non-charge expense. So without going into too much detail, for that reason, you always want, or you should always expect the CFO, cash flow from operations, to be higher than the net profit after tax, right? In this case, 2290 is the net profit after tax over the last 10 years for Kajaria Ceramics, and CFO is 2800 crores. So it's more than that. Then comes the question of capex. Now, what is capex? Capex comes from two primary categories. One is that the company has to maintain its existing assets, right? And two, it has to invest in either new factories, new assets, new land, so that it can expand. So there's maintenance capex and there's growth capex, right? If you deduct capex from CFO, so CFO minus capex, you get free cash flow, right? Free cash flow is the real juice, right, that the company really gives out to the owners of the company, right? And one interesting ratio you can use to judge or to tell how much of the CFO is being converted into free cash flow, this is the ratio. So free cash flow divided by CFO. And obviously the higher the better, right? With that said, let's move on to, so far so good. We don't see any red flags or anything like that. Earlier in the decade, the debt to equity was a little bit on the higher side. But as we have gone through the decade, Kajaria has reduced its debt. So that's a positive sign. So block number 4 is basically the profitability ratios, and you will see that the darker the color, the higher the number or better the number, right? Profit before tax divided by average net fixed assets tells us that for every 100 rupees of net fixed assets, meaning land, machinery, factories, all of that, how much profit before tax can the company generate? And naturally, the higher the number is, the better, right? ROE is, of course, return on equity. How much for every 100 rupees the owners have put into the business, how much in terms of percentage, how much the company can generate. Again, in the earlier half, we were seeing numbers such as 25, 28, 27. whereas now it has come down to 17-19. And the reason why it used to be higher earlier was because the company was using debt. So debt can increase the ROE, but obviously debt also increases the risk involved. Right. The third one is return on capital employed. So for every 100 rupees of capital the business requires to keep functioning. Now this includes equity, this includes working capital, this includes debt. So all the capital that's required to make the business continuing to function and work and operate properly. That's what ROC is. And again, it was higher in 14, 15, 16 because debt was higher at the time. But still 19. So you can see that the company has gone through a little bit of cycle because in 18, 19, 20, ROE was on the down, on the lower side, but still even in a down cycle, if the company is earning a 15, 16, 17% ROE, I think that's considered very, very respectful, right? Section number 5 is the working capital related ratios. Net fixed asset turnover, which is basically sales divided by the net fixed assets. The higher the number, the better. It tells us that for every 100 rupees of net fixed assets, how much sales can the company generate. So if you have 100 rupees of net fixed assets in the top of the cycle, towards the top end of the cycle, the company was generating 2.8, 2.82 kind of, and recently it has generated 3 times the net fixed assets, which is great, right? And again, you see there, there's a cycle where on the higher side, the NFAT ratio is higher, and in the worst of times, it is a little bit lower. Receivable days, how much time it takes for it to receive the cash from its customers. Again, you want it to be as low as possible. Inventory turnover, you want it to be as high as possible. Again, I'll write a blog, explain each of these things, how to interpret them, and I'll leave the link in the description. Okay, next is the dividend and how much retained earnings. So in this section 7, there are 2 data points that we want to carefully look at. One is the retained earnings, how much the company has retained within the business. And the best way to judge how efficiently every rupee of retained earnings, how it has been used by the company, the best way to do that is to compare it with the increase in market capitalization. So for every 1 rupee of retained earnings, the company has generated, around 10 rupees in terms of market value, which is great. And finally, this is cash flow. We will not be paying too much attention to this. So far, if you look at Kajaria Ceramics in terms of capex, in terms of the stability in the margins, in terms of debt being reduced, in terms of the profitability ratios, things are looking good. So this is a very solid company, and we definitely don't want to get rid of this right now. So we'll keep this company. We'll move on to the next. So the second company we'll discuss now is So Many Ceramics, and we'll start off with the same drill. We'll start off with sales growth first of all, and then we'll go one by one through each of the 8 sections. So sales growth, let's have a look. So 21%, okay, great start, at least for the first 2 years. Then 10.5 to -1%, 0. -6 to. So Many has basically had 6 years of pretty terrible sales growth, right? At least by the numbers, and especially compared to Kajaria Ceramics. And although sales did dip for Kajaria, as we can see over here in these years, it was still positive, except 2020 when it was -5%. Sales growth was at least in the single digits, whereas here, sales growth is not as strong as Kajaria throughout those very same years. Now, next thing we want to look at is operating profit margins. You will notice instantly that the operating profit margins are also lower compared to Kajaria Ceramics. So here they are varying between 8 and 12%. Even the variability is more, and also the operating profit margin itself is lower. Compare this to, look at this, 16, 16, 16, 19, 17, 15, 19, 17, whereas So Many 8, 7, 7. So big difference between the operating profit margins. right? So this tells us that in that industry, in the tiles manufacturing or tiles industry, Kajaria Ceramics has a business model that seems to have a better or a higher or a more stronger competitive advantage versus so many ceramics, right? Third thing, we want to look at the net profit margins. Again, because operating profit margins were lower than Kajaria, it's very likely, and as we can see, the net profit margins are also much, much lower, right? The third thing we're going to do is the same that we did last time. We'll compare the total profit over the last 10 years. Again, look at the difference in the size as well. Net profit after tax total of the last 10 years for Kajaria was around 2200 crores. Here we're looking at 548 crores. So this is obviously a much smaller company compared to Kajaria Ceramics. Now, we compare this total with CFO, and the good thing is at least the CFO is higher, so cash from operations is more than the net profit after tax, which is to be expected because of depreciation. But here's the kicker, right? So although CFO was 1209, the capex required to keep the company maintaining its existing assets and possibly growing is 1148, which means it only leaves 60 crores of free cash flow on cash flow from operations of 1209. So that's less than 5%. Compare this with Kajaria Ceramics of 45%, right? So big difference. And this is where so many ceramics really starts to kind of cause all the doubts. Okay, the next section is the profitability ratios. So earlier in the decade, it was doing much better, 27%, 39%. And then since then, there's been a decline and a sharp increase in the last 1 year, right? So it's very evident that the cycle has turned, and we know that because we know that real estate sales had picked up in 2022. They are doing reasonably well now, but we'll have to check the latest data on what is likely to happen over the next 2-3 years. ROE 13, 19, 19, 21. So A, they're very variable, right? And B, again, these last few years have been pretty poor, right? An ROE of less than 15% in a country like India is considered to be, subpar. Then we have ROCE, again, not the best, but there has been an improvement in the last 1 year, in March 2022, in the year ending March 2022. Okay. Next, we look at next fixed asset turnover. So compare this again. We have 5.68 during the best of times in the earlier part of the decade, and since then it's just been going down and down with a small recovery in the last 1 year. Right? Compare this with Kajaria Ceramics. We have 2.8, 2.8, 2.6, 3.16. Actually, at least in this, so at least in the first half of the decade, so many ceramics has a much higher net fixed asset turnover. But as far as these numbers are concerned, by and large, they're very similar to Kajaria. Right? Receivable days is, I think about the same or maybe even slightly better than Kajaria. Inventory turnover again was initially higher and is around 8 recently. So Kajaria is doing a little bit better. Okay. And then you have working capital cycle is 85 days in the last 1 year, and we have 88 days. So at least on the working capital side, doesn't seem to be a much difference between the two companies, and they're fairly similar in a lot of respect as far as the working capital is concerned. All right. So the next thing we want to look at is dividend. Again, for every rupee retained into the business, 470, the company has created around 5 times value in terms of market capitalization, and this is the cash flow statement. So I think overall, if you look at it, so many is a little bit inferior on a lot of metrics that we looked at: operating profit margin, net profit margin, CFO, free cash flow to CFO not being that great. Even profitability ratios are not that great. The only thing that it kind of compared to with Kajaria was on the working capital, but working capital alone doesn't really tell much about the quality of the business overall. And for that reason, I think compared to Kajaria, I think Kajaria is a much better company. Okay. Now, the third company and the final company we're going to discuss is called Orient Bell. And this is a much smaller company, as we can judge by the sales numbers. In 2022, it did sales of 654 crore. This was compared to so many, that number was 2,095 crores, and compared to Kajaria, that number was 3,700 crores. So this is a much smaller player in the tiles sector, right? So sales growth, if you look at 2012, it had a very high sales growth. I'm not sure why was the reason, but the rest of the time over the last couple of years, sales growth has been pretty, very below average. So nothing great happening over here. If you look at the operating profit margin, 9, 9, 10, 8, 7, 9, 6. So operating profit margins are, again, a little bit lower, maybe 1-2% lower than so many ceramics as well. So that is there. In the last 2-3 years, I want to see what the difference is. So many is 8, 12, and 10 in the last 3 years. And we have 5, 7, 9, right? So you see the difference between Kajaria versus a so many versus an Orient, right? You're seeing how the operating profit margins are trending downwards as we go from a bigger company to a smaller company, right? If you look at the net profit margins, again, they're 4, 3, 2, 0, 2, 6. Really not that spectacular. And overall, on an average basis, we can kind of see that net profit margins for so many are actually a little bit higher than Orient Bell. If you look at the total net profit after tax, it's 149 crores over the last 10 years. We compare that to CFO. That's great. CFO is more, 363 crore. You minus the capex, you get free cash flow of 238 crores. So this is one thing compared to so many that Orient Bell is doing well. So it's able to earn the cash, invest an appropriate amount, keep the business functioning, and, get a reasonable amount of free cash flow. The only thing with that is that growth, because capex has been, I believe, lower than required, because if they had invested enough in terms of growth capital, their sales would not have increased, would not have just doubled in the last 10 years, right? So it's very clear that they have not focused on building additional capacity, right? And for that reason, they do have free cash flow, and at least in terms of ratios, it's great. But this is a company that needs to focus on growth, right? If you look at debt to equity, also has decreased over the last couple of years. If you look at the profitability ratios, they're very, very average. They have 1 year of, great performance. Then again, very, very poor performance. And then again, we have. So this is a very clearly cyclical pattern that we're seeing. Of course, if we are interested, we could look a little bit more into depth about what's happening behind the scenes. Are there any changes now in the business model that can maybe ensure that going forward, these numbers will be better? So all of that is another consideration right now in this part of the analysis. All we want to know is, do we want to even spend more time on the company? And as far as the numbers look so far, there's nothing spectacular that would want you to look at it in more detail. Net fixed asset turnover is around 2-3, similar. Receivable days maybe a little bit higher. Inventory turnover is, in the last 1 year has been higher than both Kajaria and so many. Working capital cycle is a lot longer, 92 days. So many had 85 days, and Kajaria had 88 days. So yeah, working capital cycle is a little bit longer. If you look at, for every rupee retained within the business, which is a total of 138 crores, market capitalization increased by 790 crores. So that's around 6 times, 5-6 times, right? So yeah, I think this is the key section where you look at Orient Bell and think, they haven't even been able to earn a 15% on a consistent basis. Therefore, nothing in the business indicates they do have any kind of comparative advantage. Is another discussion. They're not even earning their required rate of return, right, which is usually 15% ROE. So for that reason, we would probably not want to spend more time on Orion Build as of now and focus mostly on Kajaria. Probably not even so many, but Kajaria is the best company out of the three, right? So that's how you can use this sheet to kind of screen stocks. Now, again, this is a sheet, this is a light version. There's actually a lot more we can do with it. For example, we could look into the forensics. We could look at some of the forensic ratios and see whether the company is being honest. Is there any sort of fraud situation going on? There are other features that we could add to the sheet, but this is a light version. And if you'd like to download this sheet and apply it on your list of stocks that you've created, you can actually click on the link in the description. All you need to do is fill out a simple form and just download the sheet for free. You can use it, right? So that's it for today. That's it for now. Hopefully this video has been helpful. Please comment below if you found this useful. If there's anything that was not clear, like I said, I'll write a blog post explaining the key ratios in the sheet so that you can better understand what they mean, how to interpret them, how to use them, right? Other than that, please don't forget to subscribe. And if you have any questions, feel free to drop a comment in the comment section below. Hopefully this was useful. Until next time, have a good night, have a good evening.